So really what I'm going to cover today is talking about what does forecasting mean in OpenAir, and then 3 different components of forecasting that you can use together, separately, individually, a lot of combinations and flexibility here, and then talk about a little bit about reporting and some of the key reporting values to consider. So as I look at the forecasting process in OpenAir, the most robust and detailed version of it is really a bottom-up forecasting approach, where you're taking what you would normally do from an actuals perspective and take forecast time and run through it. So if you look at the components on the slide here, there's really what does it mean to actually generate revenue, generate billing, and that typically requires you to set up it does most of the time require you to set up billing rules, revenue rules, recognition rules, and those rules require things like rates or milestones or caps or totals or some kind of monetary value. And then those rules become part of the project that when you run those rules, when actuals are in, you generate actual invoicing, actual revenue. And then from a forecasting perspective, the forecasting really says, okay, so if I'm dependent on time, if you can give me forecast time, I can give you forecast money. And that's where you're coming with the resource scheduling pieces of it for those T&M projects, or date controls for those milestone projects. And really that forecast gives you projected billing, projected revenue, and that's how OpenAir sort of reuses the same technology, but you just give it future information and it gives you future or forecast information at the end of the day. So this is the general concepts and the general approach for OpenAir. But as with OpenAir, many times you will find that this is not the only way to do things, and we are going to explore a couple other areas for consideration. So there are really 2 forecasting methods available in OpenAir for revenue. The first is what I just described. It's called a charge-based projection. So charge is a little bit of a misnomer. Charge implies billing. But the feature in OpenAir is called charge projections. We're going to touch on some of the controls for that in just a couple slides. But it's really a bottom-up calculations view. So what that charge projections is all about, and I'll jump into our OpenAir environment here, wherever it happens to be. My goodness, I have a lot of slides open. Here we go. So the charge projections area is really something that it can be configured. There's not a lot of configuration to it, but it is one of the few batch processes in OpenAir. It can be run on demand, but it is a batch process. It typically is scheduled to run overnight, and that batch process calculates your forecast from a bottom-up perspective based on the controls of where the forecast information is found, forecast time, for example. The other is something called straight line forecasting. So straight line forecasting, I don't necessarily see this as a primary dependency for forecasting by many companies, but it is sort of an early forecasting method that can be combined with charge-based projections. And the straight line forecasting is really a very simplistic spread of budget across a start date and an end date. So it does not have a dependency on rules. It does not have a bottom-up calculation. It is very much a simplified forecasting method where you're assuming the same level of work will be delivered between the start date and the projected end date of a project. And a third option that I like to throw out there, because before this feature became available, it was something that would come up in conversations with customers, but it wasn't really available, and that's something called like a manual forecast, where you're, as an owner of a business, you've trended the information. You know that you bring in about $300,000–400,000 a month. So can you just put someplace $300,000 or $400,000? Can you just type that in? And that's where the beauty of Excel works a lot with people, because they want to use Excel and they want to say, this is what my forecast looks like. It's 300, 400, 500, whatever. And they type the number into the Excel spreadsheet, and they use that as their forecast, and they run actuals out of OpenAir, and they're always comparing against it. The project budget feature that came out about a year and a half, 2 years ago now, this actually supports the ability to do that former manual, type it into a cell type forecast. So I've got a couple of slides in here just to give you some thoughts, because this is what we're going to explore next month in much more detail about the usability of it. But as it pertains to forecasting, it actually can fill a gap that exists in the forecasting methods with charge-based projections and straight line. And it also can provide you a way to sort of baseline or put in a revenue plan, for example, for the year that you could compare against. So let's first talk about charge projections. So I jumped into our OpenAir and kind of started showing you the form related to this. The charge projections feature is found under the project settings area in the system. So it's a little bit embedded in the navigation, but it's administration, application settings, project settings, charge projections. And there's really not much to configure here, but what you can configure is very important to understand what your options are all about related to the charge projections feature. So this one is the thing that's scheduled pretty much nightly for most customers. And whenever you bring up the forecasting, the charge projections feature, it shows you the last time it finished running or if it actually is currently running. So for those of you who have people who have, there are multiple people that have access to launch this manually at any given time, once it's running, you can't launch it again. It can't run in parallel. It can only run sequentially. So if you have more than one person running it, it'll tell you that it's already running. You can't run it again. But it'll have a note in here saying, oh, this is the last time it was run for me was at midnight last night is when I have mine scheduled to run. Like many of the things in NetSuite, the OpenAir system, there is a strong suggestion from the vendor themselves that don't try to schedule things on the hour like midnight or 6 a.m. or 7 a.m. Schedule it 5 minutes after, 10 minutes after, 15 minutes after, because that just spreads the workload for the servers that are providing those automated jobs, in case you weren't aware of that. So one of the first main sections, which I have a slide for, but I'm already in the system, one of the first main configuration decisions is where am I getting my charge projection hours from? So this is for those T&M type projects or like the percent complete revenue recognition. Where am I pulling the hours from to actually figure out what the future time is going to be, what the future work is going to be delivered? And this is a critical setting to think about. And some of the settings are probably pretty obvious. Assigned hours or booked hours, that's really the two major resource management, scheduling management controls in OpenAir. Assigned hours are the task assignments where you have a start and end time to the task, and that's driving the availability of the person or the assignment of the person. And the bookings, you may have called those assignments or allocations or staffings or schedulings or whatever. They're in the resources module. And those are the discrete components of I need this person to work on this project from this date to this date. But then you can repeat that for varying periods of time, week after week or every other month or something like that. So those are the two main components for any kind of future time. Now, what you may think is odd is there's also approved and worked hours, which is completely dependent on actual hours on a timesheet. So that's not so much a future time thing. That's more of using the charge projections as like a billing preview. So I do have a couple of customers that do use this as a billing preview because they're not doing any resource scheduling. So that would be a benefit to turn those options on. But the last four options are sort of the combination. This is sort of, oh, this is the perfect setting, booked and worked or booked and approved. That's perfect because as people put time in the system, it's going to refine my forecast. It's going to be more accurate. It's going to pull the actuals from time, and it's going to fill in the gaps with the bookings or the assignments. And those are good options. They do have a trade-off. So if you've joined some of our other webinars in the past, we may have talked to you about these trade-offs. The trade-off here is really depending on how you put your time in, if you don't put any time against a project that's been forecasted to do work, that time, there's nothing on your timesheet, so nothing can't replace something. And so you end up getting forecasted for doing work which actually you never got the chance to do. So there is a little bit of trade-off, and we can certainly explain that more if you want to reach out and talk about that. But those are viable options as long as there's good timesheet compliance. And there's still a management of the resource hours. Now, on this charge projections feature, because it's named charge projections, the focus is billing. However, all you have to do is check a box that says create recognition projections, and then it hooks in the revenue recognition rules as well. So it's called charge projections, but it does do revenue projections. We have to just make sure we turn that on, and you have to make sure that there's revenue rules set up on the project. Now, other components of this setup are related to when does the forecast actually populate values. So when you set up this charge projections feature, it populates things called projected X, projected revenue margin, projected billing, projected cost. All those projected values get populated at the point of the date on this charge projections form. So you see here in the screenshot we have a start date or a relative start date. And the relative start date actually was recently enhanced. About a year ago it was enhanced, so it's much more flexible and much more compatible with the needs of organizations. So in many cases companies will use things like I need to forecast from today forward, or I need to forecast from this month forward. So it's always continually adjusting according to the passing of time, versus the hard coding of a date range saying in our screenshot here, I need to start forecasting as of March 1st, 2015, and I forecast out to the end of 2018. And that static date range is perfectly fine. What that static date range does, though, is it takes the information from the charge projections configuration controls up here with the booked hours, assigned hours, and so forth, and it will actually populate forecast values historically backwards to March 1st, 2015. So later on I'm going to talk a little bit about reporting. And reporting, there's sort of a little trick that I like to introduce where feasible to show that you can add actuals plus forecast and get a reasonable total view of financials. But in order for that to work, you have to actually pick what we call a pivot date. And the pivot date is the thing that identifies everything reporting-wise before this date is populated with actual values, recognized revenue, and everything as of this date forward in the future, that's populated with projected revenue. So if you do the math, actuals from today backwards have money, but actuals from today forward are zero because there's no actuals in the future. The future values have values in the future, but they don't have anything in the past because you set up the relative range to say that's the pivot date. Last month is the pivot date. So anything before July in this example would have a value of 0. So if you really add the two together, you get a total view of revenue. And so I just gave you a spoiler alert. That's my last slide of the day. So the pivot date is something to consider as you're configuring this environment, also maintaining the data and how you're setting up the reporting to be able to view the revenue along the way. So the charge projection feature, because it does revenue recognition also, there are a large number of rule options available for revenue recognition, and the only ones that the charge projections does not handle, the only two that they don't handle, are the expenses and the purchases, because there's nothing for it to forecast against. There's no expense plan, so to speak, to put in there. There's either hours or there's milestone dates. And all of those factor in at some component with the percent complete rules, the incurred versus forecast rules, the time billing revenue rules, or the fixed amount rules. But expenses and purchases have a gap because there is nothing to really forecast against those, and we're going to address that gap later on. Now, switching gears here a little bit, the straight line forecasting actually does not care about the rules. The straight line forecasting actually is the simplified method. So the charge projections are what I believe are the preferred forecast. That's what I typically suggest to customers. But the straight line forecasting is a very simple. I really don't have a lot of data. I don't really know what the resource plan is going to be. I just want to sort of do an early forecast of money earnings potentially for this project. I know it should start around January and it should finish around April, and it's worth $100,000. So the straight line forecasting is actually a configuration setup in OpenAir, and when you have it in place, anything like the projected revenue is populated with a spread of money from that start date to that end date. Now, all of us think in terms of months when we think of calendars. So January, February, March, and April, those are 4 months. So I would expect from a straight line forecast to see 25, 25, 25, 25. Okay. However, OpenAir actually breaks everything down to an individual day level. And when it breaks everything down to an individual day level, the number of days per month varies. So in fact, in this example that we have on the screen, a straight line projection would forecast 23.8, 23.8, 27.3, and 25 simply because of the number of days that exist in each of the months. So you will see a slight variation. So the straight line is not as clean as saying, oh, divide by 4 and spread it across 4 months. It does do some calculations, but it still does a very basic calculation from a day per month type reporting. And really the setup for this, there's actually what I call an Easter egg field. This is just Jody's nickname, Easter egg field. This is if you set up this specific custom field called straight line billing projections and you put that on a project stage configuration. So everything in that stage would forecast as a straight line billing projection. That's the control. So by setting up this custom field, you unlock this feature in OpenAir, and then you're able to do straight line forecasting for all those projects that are in that stage. Okay. Now, the gap item that we talked about, expenses and purchases, is something that actually the gap can be plugged with project budgets. And so that's why I wanted to kind of introduce this, because I usually think of it in terms of a little bit about forecasting, because it does solve that last question that I get from people is, I really just want to put a money amount per month. Can I just, is there a way that I could use a spreadsheet in OpenAir to put money per month? And the answer is actually yes. It's this project budget feature. So if you're not familiar with the feature, it's a feature that you have to turn on, and you turn it on per project stage. And once it's on, it gives you the ability to basically add components of the different types of activities that you could deliver on a project. So expenses, labor, purchases, and basically what you do is you put in there what it is that you're going to add, and then you identify what the plan of that money is going to be across the time frame. Now, technically the project budget feature is a cost planning feature, and being a cost planning feature, it focuses on costs. So like the example I have on the screen here, which is airfare, I think there's going to be one or two trips. It's going to cost about $1,500, and it's going to go over the 4 months of this project, $1,500 a month. Okay, that makes sense. It's a cost planning, but to be honest, a lot of what I see people wanting to forecast revenue for expenses and purchases, they're really just pass-throughs. So it's a pass-through expense, so that you basically pass that through as revenue or reimbursed revenue from the client. It does support the ability to do a markup. So you could say the cost to us is 15, but the bill out to the customer is going to be a markup of 10%. So therefore it would show $16.50 for the billing aspect of it. So there's a cost piece and the billing piece to this feature. So it does support a markup if you wanted to have some kind of forecast reporting based on an admin fee, for example, that you would add to it. Okay. And really how it would work is, and you can do this per project, the project manager would be able to set up a project budget and say, here's where I expect to spend lodging, here's where I expect to spend airfare. And you add the expense item. You don't have to identify who. You just add what it is that you're going to be incurring. And then you identify how much it is, how many of those do you need. So here it's going to be $450 for each time, and each week I will have $450 for this lodging item occur between September and December. And so it just does the math, and it populated everything across the way when I hit save. And it said, okay, so on a weekly basis, you're going to have lodging 3 nights, $150 a night, boom, 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 boom. Okay. And so now I have my plan of cost for expenses, and then of course I can do reporting on that to say, well, here's what I expect to to burn as far as cost for lodging, and then that's going to be reimbursed. So that also gives you ability to do forecasting not only from a total money perspective, but you could also forecast total margin. So everyone knows that if you count expenses into your margin percentage, it's going to drop your margin because it's typically a pass-through, so it's 0% margin. But you would be able to see a percent with just labor and then a percent based on total cost, total billing with the expenses and the purchases. So the purchases work the same way. You just identify products. Now, what's nice about this, because I showed them like, okay, that's great, Jody. Yeah, you can spread things across month for month, but not every month's going to be the same. I would have certain weeks that would have 5 days, and certain, maybe 3 or 4 weeks in a row that we would have nothing. The project budget feature actually allows you to do inline editing, almost as if you're editing a spreadsheet. So as I'm, want to correct something here, you can see in this screenshot that I'm adjusting the airfare. So for the month of November, we're not going to take any trips. So I literally just click in that cell, type the number 0, and I hit save. And now I've adjusted the total cost for that line, and I've reduced the cost for that month. And therefore, of course, it won't forecast anything with that. So I think the project budget feature actually has a place in the forecasting features of OpenAir because it plugs that gap of expense and purchase forecast. However, based on just walking through what it can do, it does also answer the question, like I've said, that I get is I want to just be able to say, what is my revenue forecast for this project? What is my revenue plan for this project? And be able to put in there each month I should hit 100,000, 200,000, 300,000. So this is also my go-to feature when I'm working with customers that want to do something like a revenue plan dashboard. Okay, so if I go to like our dashboards here in our system, this financials dashboard has a revenue plan on it, and that revenue plan could be something taken from a project budget that you put for the whole organization or for components of the organization, maybe by practice or by service line or by business unit. And then that revenue plan could come from the project budget feature that you set on maybe an internal project. And then the other lines come from your charge projections, the charge projection feature, and this pipeline one, this prospect one, comes from your straight line forecasting. So you can use all 3 features actually to get you to where you need to be from a reporting perspective in the system. So speaking about reporting, so from a reporting perspective, when you do build up revenue forecast reports, the forecast report will focus on projected revenue as a reporting value. And you see how you see the brackets with the rules after the term of this when you see it on a report? What that means is whenever you see rules in the bracket, it is relying completely on the charge projection feature or the straight line projection feature, because the straight line projection feature also populates these same reporting values. If you see in the parentheses something called like user cost rate or primary user cost rate, those are not relying on the charge projection feature. Those are relying on real-time calculations based on information on the user record. So there's a slight difference there. You do have to pay attention to what's in the brackets. But the rules feature definitely relies on the charge projections functionality. And there's a projected cost feature, there's a projected revenue margin feature, there's a projected billing feature, of course, but this presentation is focused on revenue. So those projected revenue values are what are populated by straight line projections and by charge projections. Now, if you choose to use the project budget feature at all, those have their own reporting values, and those are all qualified by the word project budget. So it's project budget, whatever. So you got project budget expense cost, project labor expense cost, project budget purchases cost, and then there's a billing piece of it too. So if you added some kind of like admin fee or adder, you'd be able to see the cost version plus the billing version. And those are all available when you have this feature turned on to be able to pull reporting. And just like any other thing in the system, you can go to your custom calculation area, rename these if you want to some other reporting value because you don't want it to say project budget expenses cost, you want it to say forecast expense plan or something. You can rename that reporting value. If you're not familiar with that, the renaming of reporting values, it's under the custom calculation feature that's found under Administration Global Settings, and there's a rename built-in summary field. So you can certainly change the name of those project budget features if you just don't really like the terms that are being used. So here's project budget expenses, project budget labor. So those are all things that you could rename if you want to. Now another thing when it comes to revenue, and a large majority of our customers do use accounting date when it comes to revenue, because revenue is something that can be run ad hoc. Maybe there's revenue catch-ups once paperwork is signed, so accounting date normalizes the transaction information so it lines up with an accounting system. From an actuals perspective, accounting date works. It applies. That's supported in reporting, but from a forecast perspective, the system has no ability to understand what a forecast accounting date could possibly be. So even though your reports may be set up to have recognition transaction accounting date, what it will actually forecast is the transaction date. So if I forecast to work 6 hours tomorrow on the 25th, then it will forecast 6 hours for August 25th, regardless of whether I expected to take that as revenue in September or October or November. Okay, and I'm sure everyone can understand that. That's one of those variable things that we're trying to keep the data lined up. So that's how the forecast works with the dates. And then here's that spoiler alert that I said earlier in the day. So if you actually have the ability to set a pivot date on your charge projections, and the pivot date is controlling what populates in the forecasted values, like projected billing in my screenshot here, or projected cost, then you can actually add actuals and forecast together and get a reporting value called total revenue, total billing, total cost, and have that be your trending line on reports and in dashboards. So that graph that I showed you with my forecast, I actually am using a total revenue, total billing type approach because I have a strict pivot date of this month. So anything prior to August 1st in my case is all actuals. Anything after August 1st is forecast, and I can add those two nicely together. I don't have to worry about duplicating information because I have a process in place where we only populate actuals after month-end closes. But not everyone has that process. So the way I do it doesn't mean it's the right way for everyone. So we're certainly open to having dialogues with you to talk about your specific situation and see what would be a best fit for you on all that. So we are hitting at the end of our time. I'll be opening up the phone lines here in just a second. But just to kind of summarize some of the tips that we have in here, there's really 3 ways that you can augment and build out your revenue forecast. You don't have to do a single way and then have it be relying on that single way. The project budget feature is something I don't think maybe many people think in terms of forecasting, but it is a possibility to use that. And there's really knowing what your business process is, the dependencies on your data entry, and then of course the configuration controls to support that are really going to drive how you can pull those reports out of the system.